This could potentially be a once-in-a-generation opportunity to build wealth because now might be one of the easiest times to significantly increase your assets, if you know what you're doing. After all, there's a popular saying that fortunes are made in times of crisis, and it doesn't take much to realize that we are already moving in that direction. While it may sound negative, the truth is that recessions happen regularly, and if handled correctly, you can prepare for a lifetime through some incredible opportunities and discounts. Even Warren Buffett says that bad news is the best friend of an investor. So today, we will talk exactly about what to expect in the next 12 to 24 months, the best benefits you can take advantage of today, and what you can do to ensure you are in the best position to make the most money possible. Before we talk about the best opportunities that are coming, you first need to quickly understand what you are facing. To start, we need to talk about a recession. Generally, recessions come with a significant increase in unemployment, a decrease in wages, a loss of consumer confidence, and a decrease in the values of everything from stocks to food, energy, and services, sometimes with global effects. Secondly, along with the recession, there is often a decrease in profits. Every quarter, companies report their earnings and provide guidance on their future prospects. However, lately, they have been reducing forecasts, preparing for slow or even negative growth, citing recession risks at the highest pace in 10 years. This brings us to job cuts. When consumers earn less, they spend less, and when companies see less demand, they start cutting their expenses in general. Usually, employees are the first to be laid off, in fact. A quick Google search for mass layoffs shows dozens of companies reducing their workforce, as explained by the Bank of America. The U.S. economy will soon begin losing 175,000 jobs per month. So, what does this mean for you and your investments, as well as how you could use this information to make money? Let's get started. Stocks. So far, the three main indices have fallen between 20% and 30%, with analysts like Joe Morgan believing we still have another 20% to go from current levels. However, if we look at history since 1946, the average market decline in a bear market was close to 30%, with the most severe in 2009 when the S&P 500 fell 57% from its peak. Generally, the absolute lowest point occurs when we see desperation among investors. That's the time to initiate the recovery, and things start to bounce back. Real estate. Although each area is different and some locations may continue to thrive, nationwide home price drops are really incredibly rare. In the last 60 years, there have been only a few occasions when prices fell significantly more than 10%. However, the general consensus on Wall Street is that national home prices will decrease by 7%, with a worse drop of 10% to 15% if interest rates continue to rise. According to Moody's Analytics, the most vulnerable markets could see a decrease of up to 25% from the peak, with the drop lasting another 12 to 18 months before hitting the bottom. In general terms, it probably won't make a big difference for those with a fixed-rate mortgage planning to stay in their property for another 5 to 10 years. However, for those looking to invest or buy a home, we could start to see some deals appearing on the market, which we'll address shortly. Cash effect. Until now, there was a mindset that money was being wasted due to inflation. However, when every other asset is losing value, sometimes cash can be the safest place to store your wealth. And this is significant when someone like billionaire Ray Dalio admits that money is no longer trash. The truth is that many people forget that until recently, in 2018, money was the best performing asset. If you had simply saved your money in a high-yield savings account, you would have significantly outperformed the market. Money is becoming such a significant part of the portfolio that even fund managers have the highest amount of cash since 2001. And Citigroup says cash is the only asset investors can use as a hedge during a recession. Let's clarify that we are referring to a strong currency, like the dollar. If you are from Latin American countries, it's likely not convenient to have money in pesos. It would be best to have your money in dollars. In terms of why this upcoming recession could be a once-in-a-lifetime opportunity, consider the following. In my perspective, even though someone might think this is a bad time to invest because everything is dropping by 30 points, a financially successful person would see it as an opportunity to buy these same companies at a 30% discount. Warren Buffett really had the perfect analogy for this. He said that when hamburger prices fall, we sing, and when prices rise, we cry. For most people, it's the same with everything in life they are buying, except stocks. Less competition. The reality is that when times are tough, companies cut back, close down, conserve cash, and play it safe. But this opens the door for smaller and more aggressive companies to stand out and take their place. For example, a study with 16,000 companies found that those that continued advertising increased their value and got more for their money, with positive growth years after the recession ended. Historically, the S&P has averaged about a 29% drop around a recession, with an average decline of 24%. However, once stocks hit their lowest point, their average return in the following year is 40%, and in 2 years, the market has increased by an average of 58%. This means that investing in the low is much more profitable than pulling out of the market and waiting in the long term. The market has always recovered in every example throughout history. It may seem easy to think, perfect, just invest during a recession. But the truth is that recessions are never confirmed until much, much later. For example, the Great Recession that began in December 2007 was not officially announced until December 2008, just a few months before the previous recession officially ended. The previous recession began in March 2001, but it was not called a recession until November of the same year. This continues with a delay of about 6 to 12 months until we really know that we are in a confirmed recession. But in terms of what you can do about it to benefit, cut your expenses. This means tracking your spending, reducing unnecessary expenses, and operating efficiently. At the same time, reinvest as much as possible in the market. This should also include a plan for what you would do if your income decreased by 20% to 50%. How would you cover that? And if you could take preventive measures in advance to protect yourself if it happens. Keep some cash on hand. While statistically your money is better invested as soon as possible, there's something to be said for the peace of mind of having cash available just in case. For me, cash represents between 15% and 20% of my portfolio, depending on the time of year. Overall, this has provided me with many opportunities to take advantage of good deals when I find them, and allows me to sleep soundly, knowing that whatever happens, I have something to fall back on. Invest for the long term. The best action when it comes to investing is simply to carry on as usual and pretend like nothing is happening. Dollar cost averaging, or the practice of buying regularly in the market, has been proven to be the most profitable strategy. So stay in the market and keep buying. Diversify your investments. If you can't personally handle a 20% drop without panicking, it's probably a sign that you're investing too aggressively. The more diversified your portfolio is, the less likely it is to collapse if one or two of them fail. In general, this is a good time to double down on your efforts, take on an additional job, and learn as much as possible, because what you do today will be rewarded many times when the market definitively recovers. It won't be easy, but rest assured it will be rewarding for those who persevere. I hope today's video has helped you understand the market situation and prepare for the future. If you liked it, please leave a like and subscribe to the channel to not miss other content like this. Thank you for watching until here, and see you in the next video.